Bank of America warns that the summer of hell is coming. I'm your host, Steven Van Metre, and thanks for joining me today. And Bank of America's most bearish analyst is warning that hell is coming this summer as central banks tighten and are about to send stock prices much lower. Let's kick this story off when we go back to Hartnett's Flow Show, where he headlines that is back on. Now, this is back from May 26th. I want you to see the setup of where he's going with this because the picture is pretty ugly. Now, his first chart from over a week ago was that investors were extremely bearish, and that, of course, is generally not good news. And in response to that, what happened? Well, we saw the largest inflow to equities in 10 weeks as bearish investors came flooding back into the market. And where did they do that at? Well, right here on the S&P 500, between 3,900 and 4,000, retail investor flow was the highest level in 10 weeks as money came pouring back into stocks. But he says there was also massive outflows in technology stocks, as we know, as tech, which was one of the darlings of Wall Street, is now suddenly nobody's interested anymore. So I want you to understand the setup so far is that money's flowing out of tech stocks and into the S&P 500, into the broad index, as investors now turn their back on tech and look to the broad equity market for future gains. Let's continue on, because he noted that money is now starting to flow into government bonds. And we talked about this on a previous show, where large money managers are starting to look at the bond market and saying, we don't think yields can keep going higher. Meanwhile, retail investors and algorithms and hedge funds are still short the bond market, saying we think rates are going even higher with inflation. But big money managers are saying, no, we think the opposite's about to start happening, and they're putting their money right where their mouth is. So we're seeing money now back into bonds. And if you look at how Bank of America's private client are holding their money, when we look at equities as a percent of assets under management, they're sitting at 62%, just off the high of 66% here recently at the peak of the market. And I want to point out that going into the great financial crisis, that the peak investors had only 56% of their portfolio in equities. And coming out of the great financial crisis, that rose to 63% before we almost went into a recession between 2015 and 2016. And then after the pandemic, which barely got to the lows, their low was back near the high of the great financial crisis, it shot up to a record level of 66%. So now what you see is investors are very bearish, but they're not only holding equities, they're buying more equities. And what are they selling to get that? Where is that money coming out of? Well, it's coming out of the bond market. So when he looks at how Bank of America clients are holding their positions in bonds, well, they're down to 18%. And so people say, well, interest rates can only go up. Well, nobody really owns bonds. And imagine if all these people back from the great financial crisis, who at one point held 34% of their portfolio in bonds, started to come back into the market. Well, that's going to drive interest rates down and bond prices much higher. So far the setup is you see a huge high allocation to equities, a very low allocation to bonds, and about a normal allocation to cash at a point where investors are massively bearish on the markets, but still committing more money on the hopes of a bear market rally. Now let's fast forward to this week, where Hartnett is back, and this is what he has to say this time. On the Flow Show, he says the bull bear indicator dropped to 0.4 from 0.6, equaling S&P 500 at 4,400, which he says is where we're going to be short. And he notes that the bull bear indicator actually got worse after investors came pouring back into stocks. Now, this is something you wouldn't expect, as people are buying the dip, hoping to see a big rally, but that rally got cut off really fast. And of course, maybe that's why we see sentiment staying low. But what are Hartnett's reasons for this summer of hell, for things that are about to get much worse? Well, the first place he cites is, of course, the employment data. And he notes here that as the federal funds, and he says the central banks are getting started. Now, we know the central banks are getting started. Why is that? Because in less than 2 weeks, we have a 50 basis point rate hike. The following months, we're expecting another 50 basis point rate hike. And at the same time as the Fed meeting this month, the official kickoff of quantitative tightening begins. And then after 3 months of that, the cap goes up. So the central banks are going to get aggressive, particularly the Fed. And Hartnett says that has big ramifications on the labor market. And what he's showing here is as the federal funds rate rises, now it doesn't matter in this case whether it's a combination of quantitative tightening and the federal funds rate going up, the small businesses, jobs hard to find, well, that actually starts to go down as jobs become harder and harder to find. An easier way to look at that is a chart we looked at this week of job openings from the JOLT survey, job openings and labor turnover survey, against the Wilshire 5000, in red the total U.S. stock market. And we know that the stock market is the U.S. economy, and as stock prices start to go down, as we've seen in the past, well, job openings fall. And what's the second shoe that drops? Well, that means when companies stop posting as many jobs, well, they stop hiring as many people and maybe even start to lay off. So on this chart, we've got the non-farm payroll report, which was a beat on Friday and likely not to continue that on a year-over-year rate of change against the Wilshire 5000 on a year-over-year rate of change. And what do we see here? As equity prices start to come down in red, what do we see? That the year-over-year rate of change in non-farm payrolls falls, which suggests what's going to happen is that beat that we saw on Friday is going to start becoming a miss as fewer and fewer employers hire, because the wealth effect is getting evaporated. But it doesn't stop there, because when we now overlay the 4-week moving average initial claims just to prove Hartnett's point that the stock market is critical here and the Fed is going to bring equity prices down as they've talked about, what do we notice? That as the 4-week moving average of initial claims rises, it does that in response to a falling equity market. And we see as equity prices start to come down on a year-over-year rate of change, that all of a sudden you notice that more and more people are losing their jobs. And as the equity market comes down, we can sort of predict now that we're very close to a bottom in initial claims, and employers are about to start laying off, and slowly at first, and then all of a sudden really quick. Because again, we come back to the wealth effect here, that without money being generated from the market to spur spending, consumers pull back, especially in the wake of high inflation. And next thing you know, demand starts to fall. And next thing you know, after that, employers start to lay off. Let's continue on, because what he's saying here is, look, we will fade the S&P 500 at 4,200 and short it at 4,400. That's our advice to our clients. And what he's saying is retail bought here, we're saying sell here. And if for some reason the retail keeps driving prices up to 4,400, get short, because it's going to get a whole lot worse. And if Hartnett's right and the market's about to crash, well, there's one thing that shouldn't be crashing with it, and that's your portfolio. I'll put a link up here to Portfolio Shield and description below. Check it out when you have some time. You'll be glad you did, because Hartnett, well, he doesn't stop with just the labor market. He gets a lot worse, as he talks about crude oil being a major driver of what will blow up the markets, something we've talked about over a lot during the show over the past several months. And he's saying that oil prices have an annualized 108% gain, and that was only surpassed in 1999 and 1974. And he points out that when you have these big shoot up in oil, you see an oil shock. But now look at modern day dot-com bubble, great financial crisis, and look where we're at now. He's saying is, look, this is about to burst the bubble. And sure enough, because a lot of people think that high energy prices are really good, but that is actually not the case at all. I want you to first look at this chart, and then we'll discuss why. Because when energy prices go up, and here you see crude prices in blue, this is West Texas Intermediate, against the gross domestic product on a year-over-year rate of change. Notice that as crude prices go up, we see it here back in the 90s. What happens? The economy slows down. You see economy slows down, crude prices rising, and at first it's okay. Economy slows down, crude prices are rising, economy stagnating, crude prices rising. You can guess where the economy is going. And why is that start to happen is because you think about people's budgets. We look at the summer, we know it's going to be a very hot summer. Now imagine if energy prices fell by 90%. If your electric bill dropped by 90% this summer, if your gas bill dropped by 90%, if it cost to fill up your car dropped by 90%, the cost to get in an airplane, travel on vacation dropped by 90%. You think about if all these prices drop, you have more money, you could have more consumption. But there's one thing that people cannot change in their budget, and that is the price of energy, because there is a minimum amount of money that they're going to put in their gas tank. There's a minimum amount of money they're going to put into their electric bill. And all all these energy costs. There are some cutbacks you can make, but not enough. And that's why we see that high energy prices actually are really bad. If you want to see an economy grow, well, one of the big things you need in that recipe is cheap energy. And sure enough, energy prices likely to continue higher. Well, many people think so, but that's not the case. If we now take that same chart of West Texas Intermediate crude and put it on a year-over-year rate of change against the Wilshire 5000 on a year-over-year rate of change, and notably here in red, as the stock market goes down, yes, crude prices can rise, and then they come crashing down. And here you can see the market's coming down, crude prices rising, and next thing you know, they come off their peak. And sure enough, the market is going down, and crude prices, well, they will eventually come down because, again, without the wealth effect, people have to cut back somewhere, and ultimately they cut back on spending because they can't cut back that much on their utility bills. Let's continue on, because he's also warning that QE was a catalyst for this tech boom, and now with central bank liquidity getting drained, something we talked about recently, that hey, this is bad news for stocks. And sure enough, he's forecasting that the central bank liquidity is going to continue to fall, and that's going to put downward pressure on some of the biggest names: Apple, Amazon, Facebook, Google, Microsoft, Netflix, and Tesla, notably, which are in the S&P 500 and investors are plowing into. But let's look at this chart, because I've took the monetary base and put it on a year-over-year rate of change, overlaid the Wilshire 5000 on a year-over-year rate of change. Now remember, the monetary base, this is the Fed's balance sheet. It's in blue. And I want you to see the overall nice relationship, except during periods of a crisis when the Fed's balance sheet rises and stock prices go down. But notably here, we see the Fed's balance sheet on a year-over-year rate of change falling and dragging the stock market lower. And with, of course, the Fed raising the funds rate and now set to unwind its balance sheet, or start the unwind in less than 2 weeks, well, we know that that rate of change of the monetary base is going to fall. And when interest rates start to fall, we're also going to see all that money that's held in overnight reverse repo from money market funds, well, that will flow off the Fed's balance sheet and back into funds as rates fall and money market funds chase declining rates. But Hartnett, well, he didn't stop there, because he also said that as the Fed raises interest rates, which we've talked about, and he's talking about real rates now, which is inflation-adjusted 10-year Treasury yields, when they get too high, it pops the bubble. Now, what is that reason? Now, we know, because we've talked about this almost every week, what happens when rates rise? What is the counterpoint that you need to support higher rates? Well, you need an increase in lending demand, as we've been following for weeks and months, that lending demand, particularly in those very cash-heavy, profitable refinance loans for the banks, are declining and near very low levels. So high rates lead to contraction in credit, and that's bad news. Of course, why he's saying that, of course, as real rates get high, they eventually pop the bubble, because as money creation goes away, well, that's bad news for a debt-based economy that relies on the expansion of money to create economic growth. He also notes that bond flows are starting to pick up as the first inflows to bonds in 9 weeks, as investors, perhaps maybe big money managers, look to the safety of the bond market. And he also notes that retail investors, instead of buying safety, are now flooding into corporate high-yield bond market looking for yield as an answer to what they believe is higher inflation. Of course, if Hartnett's right and the summer of hell is coming, things are about to get much worse. And as long as the Fed's committed to their path of raising rates and unwinding their balance sheet, draining liquidity, perhaps even contracting the money supply, well, Hartnett's not just going to be right, he's going to look like a rock star. And of course, we'll be there with you the whole way. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.